Hi, Larry Berman here, and here's what's on my radar this long October holiday weekend. It's golf and only golf. No, it was the start of our BNN virtual road show this week. We had an excellent guest, Larry McDonald of the Bear Traps Report, and on Twitter at ConvertBond, and he's a must follow. We talked about a lot of issues, a lot of items. His biggest theme that we talked about was this whole ESG miscalculation where the powers that be in the world have pushed us to think ESG, and there's been a dramatic underinvestment in coal and in gas, in traditional carbon sources in oil, and we're likely going to experience a lot of energy market inflation in the short run because of it. On the opposite side of that, you have a deflationary trend that's been in place for forever, and with inflation continuing to surprise on the upside in the short run and transitory maybe a little bit longer, that the long duration asset growth, call it the NASDAQ 100, is likely to underperform. So he sees this major trade here, and we have to agree from a trading perspective that you want to be very cautious on large cap US. Big tech is a huge part of that, but the NASDAQ in particular. So for the first time in a little while, last time we saw this was in March, April, where we saw the NASDAQ roll over, come back to test the 50-day and fail, but ultimately break through. We did it again in May, broke the 50-day, came back to test it, broke through. And this time around, so far, we rolled over, we broke the 50-day, we rallied back, and looks like it's failing at the moment. Incomplete pattern, can't tell for sure, but have a look at this. Where's support if we break? Well, the rising 200-day hasn't been tested since pre-COVID. So March 2020 was the last time we tested and broke the 200-day. That is just above 340. We're currently sitting at 361. So call it a 5% correction risk minimum for NASDAQ before that support is tested. But if we talk about retracements and what Larry thinks is a much bigger trade here, where money comes out of large tech and goes into the inflation hedge, natural hedge, which is the energy stocks, XLE, then there's a lot more to go here. And the next real big support, technically, as we highlight on the chart here, is around the 300 level. So again, not quite 20% from where we are. That would translate easily into another 5 to 7% for the S&P 500, assuming that, with yields rising, banks still do okay and energy does well. That part offsets some of the down move, and the rest of the market just kind of spins its wheels. That would be 5 to 7% more, and get the S&P 500 down towards its rising 200-day average, currently about 1% below 4,200. So that's what we think the scenario is. That's what the talking points, I think, are all about. And as we give thanks this weekend for our bounty, let's think about that a little bit from an investment perspective. So the bull and bear pick of the week is obvious. Our bull pick of the week has been the commodity hedge and energy. Now, we liked it weeks ago when we were about 15% lower than where we are today. We're on the verge of breaking out in the XLA. I still think there's another 5 to 10% more potential there in the energy names before we want to get out of them and take a lot of money off the table there, or certainly reduce positions. And let's be cautious on the broad market overall, but if you're looking for a short, it's got to be in the Qs, at least for the next month or two. Anyways, have a great week, everyone. Have a great long weekend, and we will see you next week. Remember, Thursday nights at 7, our 10-week webinar series of Investor's Guide to Thriving. This week, we will focus on everything that isn't the investment side. So everything up to making that investment decision, which is the goal of investing, financial plan, making sure that your investment portfolio suits what your goals are. Have a great week, everyone.